All right, let's get right into it. Welcome to today's Explainer, where we're unpacking a highly analytical breakdown of the U.S. sales and use tax system, specifically focusing on how it impacts global digital service providers. If you are operating a digital business right now, selling software, online courses, or cloud services into the United States, you are currently navigating what is arguably one of the most complex, fiercely fragmented tax environments in the entire world. And you might be asking, why does this matter so urgently right at this exact moment? Well, it's because the sudden, massive explosion of remote work and borderless e-commerce has effectively pushed thousands of entirely unprepared founders directly into a massive operational landmine. So today, we're going to completely dissect the hidden mechanics, the legal triggers, and the incredibly costly assumptions that frequently trap international entrepreneurs. To give you a clear roadmap, we're breaking this down into 6 core areas. 1. The U.S. tax paradigm. 2. The actual mechanisms of sales tax. 3. The triggers of Nexus. 4. Taxation on digital services. 5. Entity structure and liability. And finally, 6. Strategic compliance and risks.
Starting right off with Section 1, the U.S. tax paradigm and why it functions as such a heavily decentralized system. To really understand this, we first have to completely dismantle a major misconception by establishing exactly how the U.S. model operates compared to standard global frameworks. You see, the way the U.S. handles indirect tax is structurally completely foreign to what most international operators naturally anticipate. Unlike a global value-added tax or a GST, which systematically applies at every single stage of the supply chain, the U.S. system is strictly a pass-through tax. This means only the final end consumer is legally meant to absorb the cost. But here is the non-obvious operational trap that catches so many businesses off guard. Because business-to-business transactions are generally exempt from this tax, sellers have to meticulously manage, collect, and validate exemption certificates for every single B2B client. And the catch? These certificates are not permanent. They expire. They vary widely from state to state, and they require strict, continuous auditing. If you fail to collect or renew a valid certificate at the exact time of the transaction, you, the seller, are held entirely liable for the tax you failed to charge. It instantly turns a simple B2B software sale into an absolute administrative nightmare that directly eats into your profit margins.
And this dynamic perfectly illustrates the ultimate fail-safe mechanism of the U.S. system, which is the use tax. If a transaction occurs and the seller, for whatever reason, fails to collect the necessary sales tax up front, the legal burden doesn't just vanish into thin air, it simply shifts. The state never loses its revenue. Instead, the consumer becomes legally obligated to calculate and remit that tax directly to their state government. Now, while individual everyday consumers rarely report or pay use tax on personal items, forensic tax reviews show a very different reality for corporations. Businesses are audited for unpaid use tax constantly. It's a massive B2B risk, meaning states aggressively target corporate purchasers precisely because they have the cash reserves to pay those use tax penalties, making it highly lucrative for state auditors. Together, sales and use tax basically guarantee the revenue is always captured, one way or another. Moving on to Section 2, the mechanisms of sales tax, or more accurately, the incredible fragmentation of it. We really need to leave the theory behind for a minute and look at the mathematical reality of compliance in the US. There is no national sales tax, none at all. Instead, there are 50 individual states, and for tax purposes, you have to treat them essentially as 50 entirely independent countries. Now, a few states have zero sales tax, but the vast majority aggressively write their own independent tax codes, completely ignoring what their neighboring states are doing. This total lack of alignment means these 50 jurisdictions have entirely conflicting definitions of what even constitutes a sale in the first place. One state might tax the initial download of your software, another taxes the recurring access to it in the cloud, and a third taxes the ongoing license agreement. It makes a unified, one-size-fits-all national strategy utterly impossible to execute. And it gets far more complex when you drill down deeper. Macro-level compliance data reveals that there are over 14,000 distinct tax jurisdictions in the US. Why? Because the legal authority to tax is not limited to just the state level. Counties, cities, and local municipalities all hold the legal authority to impose their own local tax levies directly on top of the state rate. So, for instance, a city might quietly add a 0.5% tax specifically to fund a new transit project or a local school district. This local tax operates completely independent of the broader state budget, yet as a seller, you are still legally required to accurately identify, calculate, and collect it from the buyer.
When you add all this up, this localized layering culminates in approximately 50,000 different tax rates across the country. And remember, this is not a static system. Industry data points out that there are roughly 3,000 legislative changes to tax codes in a single year alone. Just think about that volume for a second. That is nearly 10 changes every single day. A tax system or a pricing structure that you configured perfectly, 100% compliant on a Monday, might actually be legally non-compliant by Friday. The sheer chaos of this environment dictates that relying on manual updates or basic spreadsheets is an immense, almost reckless organizational risk.
To understand exactly how these cumulative taxes stack up, let's consider a specific example, like a buyer sitting in Santa Monica, California. They don't just pay a flat California state rate. They pay the state rate plus the Los Angeles County rate plus a specific Santa Monica City rate, creating a unique cumulative total. So the implicit assumption that you can just broadly charge a generic California rate to anyone in the state is entirely false. Furthermore, relying on standard 5-digit zip codes is dangerously inaccurate for mapping these tax boundaries because two neighbors living on the exact same street might cross an invisible municipal line and be subject to completely different tax rates. True compliance requires pinpoint accuracy, relying on full 9-digit zip codes, drilling down to the specific physical delivery address of the digital buyer. Which brings us to Section 3, the triggers of Nexus, which is really the catalyst for your liability. We absolutely have to establish this concept of nexus. It is essentially the legal catalyst that forces a foreign or out-of-state entity into mandatory tax compliance. It's binary. Without nexus, you have no obligation. With it, you are entirely liable. Now, historically, nexus was purely physical. If you had an office, employees, or even just physical servers located in a state, you triggered physical nexus. But today, specialized compliance audits show that the far greater trap is economic nexus. Even a completely remote entity operating entirely from a different continent will trigger economic nexus simply by selling enough digital goods into a specific US state. And these thresholds are shockingly low. We're often talking about just $100,000 in gross revenue, or critically, as few as 200 individual transactions, completely regardless of the dollar value. This means selling a $5 SaaS product can easily cross that 200 transaction limit and instantly bind your entire company to that state's tax laws, triggering massive compliance costs. The crucial point to understand here is the cause and effect timeline. Once you cross that economic threshold, you legally establish nexus. And here is the hidden mechanic that catches everyone out. These thresholds are almost universally calculated on a trailing 12-month basis. This means your liability can trigger mid-month or mid-transaction, completely unannounced. From that exact moment forward, you are under a strict legal mandate to accurately calculate, collect, and remit taxes directly to that specific state's government. You've essentially just become an unpaid tax collector for a state you may have never even physically visited. Let's transition to Section 4, Taxation on Digital Services, dealing specifically with intangible assets. When we move into digital assets, we have to analyze how intangible products are categorized within these wildly conflicting state definitions. You see, digital service providers frequently operate under the implicit assumption that intangibles are entirely exempt from sales tax simply because nothing physical is changing hands.
However, we have to look at why states are aggressively shifting their focus here. As the entire global economy transitions away from physical goods and moves toward digital subscriptions and cloud computing, states are losing out on massive amounts of traditional brick-and-mortar tax revenue. So to bridge these huge budget deficits, independent legal frameworks across various states are aggressively rewriting their laws to explicitly target digital courses, cloud software, mobile game subscriptions, and even digital marketing services. To really grasp this, consider the sheer absurdity of product categorizations in this environment. Forensic tax reviews highlight that a single software product can be classified in over 450 conflicting ways across the US. One state might classify your software as a medical utility, another might view it as a cosmetic service, and a third just calls it general software, with all three carrying completely different tax burdens. When you extrapolate this math out, if you sell just 3 distinct digital products across 50,000 jurisdictions, you are literally looking at over 150,000 potential tax permutations. This staggering data point proves that manual tax calculation for digital products is not just difficult, it is a mathematical impossibility. Using manual spreadsheets becomes a severe legal liability the very moment your business starts to scale.
Moving right along to Section 5, Entity Structure and Liability, focusing on formation strategies. How you actually structure your U.S. entity heavily dictates your reporting requirements to federal tax authorities. Actionable compliance frameworks point out a really stark difference here. If you operate a foreign-owned LLC with no physical U.S. presence and no effectively connected income, meaning you aren't utilizing U.S. infrastructure or local agents to generate that revenue, you are typically only required to file an informational return. It basically notifies the government of your existence, but usually doesn't result in an income tax payment. Conversely, entities with actual U.S. operations are subject to taxable returns. But here is the absolutely critical operational distinction you need to internalize. While foreign owners might structure themselves perfectly to avoid U.S. federal income tax, that exact same structure provides absolutely zero protection against the state sales tax nexus we've been discussing. Federal income tax and state sales tax operate on entirely separate, completely distinct legal tracks.
And this brings us to a massive pivot point in our analysis, and perhaps the single most common structural misconception among international digital entrepreneurs. A lot of founders assume there's a simple geographic loophole. They ask, does forming your business in a tax-free state actually eliminate your sales tax obligations? The short answer is no. The implicit assumption that forming a company in Delaware or Wyoming somehow magically shields you from taxes elsewhere is legally false. Yes, those specific states have zero local sales tax. But if your Delaware company sells a digital subscription to a consumer located in California, California's tax laws apply. The tax liability is dictated exclusively by the buyer's geographic location, not the location of your corporate headquarters. Furthermore, forming a business in states like Wyoming or Delaware for these supposed tax benefits actually creates a baseline of mandatory reporting. You are automatically subject to annual state franchise taxes, which are mandatory flat fees you have to pay for the mere privilege of keeping your company legally active, even if your U.S. revenue drops to absolutely zero. Finally, let's wrap up with Section 6, Strategic Compliance and Risks, or more bluntly, the actual cost of inaction. We really need to conclude by looking at the tangible financial risks of ignoring this incredibly dense framework. The data here reveals something incredibly unforgiving about the math. If you are audited and found non-compliant, back taxes are typically assessed directly against your top-line gross revenue, not your net profit. This mechanism alone can instantly bankrupt a low-margin digital business because you are forced to pay those uncollected taxes out of your own pocket, plus compounding interest, plus severe state fines. Broad expert assessments note that these punitive penalties range anywhere from 3 to 10 times the cost of simply deploying compliance automation software in the first place. And here is a highly actionable, highly non-obvious detail that requires your extreme urgency. Your liability begins the very second you trigger Nexus. A lot of global entrepreneurs sell into the US under the radar for months or even years, easily trigger economic nexus, and then decide to formalize things by incorporating an LLC. Be warned, the very act of legally registering an LLC puts you firmly on the state's radar. It acts as a glaring beacon that invites state auditors to look closely at your entity. The moment you formalize, tax authorities have the legal right to look back at your historic sales data, meaning those past unregistered sales can result in immediate audits and massive retroactive penalties right as you were trying to launch your official company.
As we wrap up this explainer, I want to leave you with a final, truly provocative thought. Think about the sheer scale of the system we've just analyzed together. 50,000 distinct tax rates, 3,000 yearly legislative changes, trailing 12-month economic thresholds, and fiercely complex nexus laws. Ask yourself this: is your current operational infrastructure genuinely robust enough to automatically map 150 million individual U.S. addresses to their precise, constantly shifting tax liabilities without any manual intervention? If the answer to that is no, it is time to seriously rethink your compliance strategy before the liabilities catch up with you. The U.S. tax system doesn't care if you didn't know the rules. It only cares that you didn't pay. Thank you for joining this explainer. Take the time to audit your systems, update your operational assumptions, and above all, stay compliant.